All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Friday, everybody. Happy Jobs Day, happy November, all that happy stuff. Top story this morning is the jobs report. What jobs? That's what I got to say. What jobs? 12,000 jobs added. That's the headline. That's what you're going to see on CNBC. You're also going to see, oh, don't worry, it was just Hurricane Helene. It was just Hurricane Milton. Don't worry, it was just the Boeing strike. All right, as if we care why jobs aren't there. 12,000 jobs added. The market was expecting 113,000 jobs to be added. Slight miss there of just 101,000 versus what the market was expecting. But that's not even the big story, guys. The big story is something we have been seeing over and over and over again for years now. The downward revisions. Errors are always in the same direction. The errors always make somebody look better, and then, very quietly, we just downward revise them later. Look at the downward revisions in this jobs report. All right. September's number downwardly revised by 31,000. Remember that amazing September jobs report? 254,000 jobs added. Oh my God, my economic plan is so good. Yep. 31,000 of those up in smoke, and they're probably going to lose even more of them next month. So we got 31,000 taken away from September, but that August number, whoa, nobody's talking about that one. An 81,000 job loss to the August non-farm payrolls. Huge downward revision there. So let's add up the downward revisions. 12,000 jobs added in October, minus 31,000 taken away from September, minus 81,000 taken away from August. We have got a net loss of a perfectly rounded 100,000 jobs for the month of October. It's the best economy ever. Now, guys, they're gonna be out there trying to water this down and trying to wash it away, saying, don't worry, it was just a hurricane. There's two hurricanes and a big strike. And for sure, those are having an impact. Make no mistake. You could see it in the transportation manufacturing numbers. I mean, that is straight up your Boeing there. But also hidden within those trade or transportation manufacturing jobs, also keep in mind, you've got things like layoffs in the automotive space that we're seeing all over the place. So they're just going to try to explain this away as saying, don't worry, it's just Boeing. No, it's not just Boeing. It's Boeing, and we're seeing warn notices all over the place in the automotive sector. And by the way, those job losses don't even show up for several months on the unemployment rate. So look, guys, the job market, been saying it for years. It's not nearly as tight as we've been saying. And, we're seeing it today. Massive losses in jobs, 100,000 jobs lost once you factor in those downward revisions. And of course, the market likes this. Stocks are up on this news. You wouldn't think so, but stocks are up on this news. Now, I have been saying for years, guys, they're going to turn the money printers back on. Everybody's going to forget all about inflation. Why are they going to turn the money printers back on? Because we beg them to. And you can see it in those CME futures today. 50 basis points is back on the table, boys, back on the menu. It's only about a 1% likelihood now, but already you've got people talking about 50 basis point cuts from the Federal Reserve. I'm telling you guys, Zerp and Burr, they are coming back. And you can see it. Gold is rallying since this jobs report. Silver's rallying. Bitcoin is rallying. Bond yields are rising. Bond yields are falling. Bond prices are rising. Not a good jobs report. Also, we got a lot of data. A lot of big earnings came out. We had big tech earnings. Apple, Amazon, both reported yesterday. Apple's numbers were okay, but not really. Revenue up 6.1%. Decent little bit of growth in revenue there. Earnings per share took a huge hit at Apple, down 44% year over year. But that was driven almost entirely by that big European Union tax bill. We covered that in the live streams a couple of months ago. They got slapped with a $14 billion bill because the European Union says, Ireland has low taxes and we don't like that. So give us $14 billion. And somehow Apple has no choice but to comply. So if you take away that big European tax bill, Apple's earnings per share were actually up 9% year over year. So decent number. Apple's services revenue still growing double digits year over year to $25 billion in revenue. So services is becoming an increasingly large portion of Apple's business. But still the narrative right now is slowing sales in China. And that is a drag on Apple stock this morning. A lot of concerns about Chinese consumers just not opting for Apple products. We also got earnings from Amazon. Again, 11% year-over-year growth in revenue. Operating margins look great at 10.3% versus 6.4% yet last year. Cloud revenue up 19%. There's their data center rentals. What else? We got advertising revenue up 19%. You know, Amazon lost $1 billion on Rings of Power, which was so awful. And now we all have to watch ads on Amazon Prime because, I don't know, because they decided they want to make Galadriel a badass for some reason instead of a wizard. Also going on, what else did we have? We got online sales rose 7%. Online store sales at Amazon. And that's the big thing. Basically, in this Wall Street Journal article said it, people are spending more money on toothpaste and razor blades at Amazon, and they're using that money to finance, along with the money from layoffs, by the way, to finance their investments in artificial intelligence. Amazon is looking at continuing their huge CapEx spend on NVIDIA GPUs. So that's bullish for NVIDIA this morning. Also going on, we got a big offer from Boeing just came out. It is a pretty sweet deal. If the union doesn't take this, then I don't know what they expect. Boeing is now offering a 38% raise plus a $12,000 ratification bonus, along with several other goodies like 401k match. Pretty amazing offer from Boeing. The union has already endorsed it, or at least the union leadership has endorsed it. It hasn't gone up to a vote yet, but it looks like that strike will probably be over in short order here. And last but not least, we got earnings from Exxon Mobil and Chevron. The two big oil majors reported today. Exxon's earnings per share down 15% off of lower oil prices. Chevron, very similar, down 17%. Although both stocks are actually up about 2% on this news, market had already priced in that negativity from lower oil prices. ExxonMobil's raising their dividend, and Chevron is warning about layoffs and talking about outsourcing white-collar jobs. That's something to pay attention to. Got a lot to talk about this morning, guys. Why don't we shrink my big melon of a head? And if you feel so inclined, if you wouldn't mind hitting that like button while we're here, it sure helps me out. And if you're new here, hit subscribe so you can come and have your coffee with the Melon Heads every morning, because we do this one every day. Check out the S&P 500. It is up about 0.5% or 27 points today after a relative bloodbath yesterday. You may notice a little bit of volatility here starting around 8:30 a.m. The market liked the jobs report, although it's given back some of those gains now. The Dow, meanwhile, is up 200 points. Again, liking that jobs report here, 0.5% higher. And the NASDAQ is also up about 0.5% here, 94 points to the upside, giving back some of that initial enthusiasm from the jobs report now after the market, I guess, comes to its senses. Now, look at the U.S. dollar here. The DXY took a big plunge right around 8:30 to 8:40, came down pretty sharply here. That is the foreign exchange market saying the Federal Reserve is probably going to be more aggressive with their interest rate cuts after this jobs report. 103.81 for the DXY. That's down about 16 basis points here. And the bond market has been particularly volatile. We've had something like an 11 or 12 basis point swing in the 10-year yield just since that jobs report came out. Now, earlier this morning, the whole yield curve was in the green here. Rates were moving higher, bond prices were moving lower. Then out comes that jobs report, and then instantly the 10-year started trading in the red here, as I'm talking about yields, by the way. So yields moving lower, that's people piling into the relative safety of bonds. We got the 30-year Treasury at 4.46. That's down 1.5 basis points. The 10-year, 4.248. That's down almost 4 basis points. It was up 6 or 7 at one point this morning. The 2-year, meanwhile, 4.100. That's down 6.5 points. And even the 1 month is down 4 basis points here at 4.646. The 1 month making a big move like that, that's interesting. That is the market saying, hey, maybe 50 basis points might actually happen again. And if you look at the CME futures here this morning, guys, this big 98% number, that's your 25 basis point rate cut. But you'll notice here, 425 to 450, your odds of a 50 basis point rate cut, which didn't even register yesterday. Yesterday, no rate cut was sitting at about 7 or 8%. Now that doesn't even show up, and 50 basis points is back on the menu here. 1.2%, still a long shot, but people are talking about it. And I have no doubt that some Wall Street muckety-muck is going to be on CNBC today begging Jay Powell for 50 basis points. Please, sir, can I have some more? They want their endless inflation of the asset bubbles. So we got that going on this morning. Also, looking over at the commodities board, we got a lot of green. Again, people are expecting dollar debasement, and so commodities are doing well here. We've got gold is at 2,761. That's up about 17 bucks. Gold had a rough day yesterday, recovering some of that here, 0.6% higher. Silver's back over $33 at $33.05 for spot silver. That's up about 39 cents or 1.2% higher. Copper's up by 1.3%. Platinum is up about 1% here. Palladium is up 2%. And crude oil, pay attention to crude, guys. Back above 70 bucks here, 71.09 for December WTI futures. That's up about $1.80 or 2.6%. I'm starting to hear rumors. All right. Now, I don't want to pound the war drums, and I know there's a little bit of like fatigue on this whole Israel-Iran story, but supposedly the Iranians are saying we are now going to retaliate for the Israelis retaliating to the Iranians retaliating to the Israelis retaliating back and forth. I don't know who shot first, to be honest with you. I don't care at this point. I'm tired of this whole stupid story, but it looks like more missiles are coming, and oil may be front running that because the Israelis, because they got a lot of goodies from the Biden administration, showed a certain degree of restraint by not targeting the Iranian oil infrastructure with their retaliation last week. Well, if the Iranians decide they're going to launch another missile barrage, maybe the Israelis don't show that restraint next time. And so oil is starting to front run this. Good God, will you guys just knock it off over there? We've got Bitcoin is also moving this morning back at $70,150 as priced on Coinbase. Now that's down a couple of bucks. But if you zoom in here, you can see a big wick at the bottom of this red candle here. Bitcoin was as low as 68,000 bucks this morning. It was down about $2,000. Ever since that jobs report, we've seen Bitcoin rally a little bit here. Again, Zerpenber is coming back, and Bitcoin can sniff that out. Now, if we zoom way out on this Bitcoin chart, you can kind of see a little bit of a pattern here. You know, we broke out of this bear or bull flag a couple of weeks ago, and we've been moving up, but we have come pretty much to this level here. We got a little bit of a double top that may have formed here. Not surprised to see a little bit of resistance around those previous highs. So Bitcoin right now bumping into a little bit of resistance here. Not surprised to see that, although this bad jobs report and the prospects of a more dovish Fed should be very bullish for Bitcoin. Now, let's talk a little bit about the jobs report, shall we? It was not good here. The U.S. economy added 12,000 jobs in October of 2024, well below the downwardly revised 223,000 in September, and well below those forecasts of 113,000 jobs. It's the lowest job growth since December of 2020, when 243,000 jobs were lost. Now, they're saying this is due to the impacts of Hurricane Helene and Milton, as well as strikes at Boeing and hotels in California and Hawaii. By the way, the California hotel strikes in Hawaii, I wasn't even really aware of those stories. But they're basically chalking it up to these one-off events. They're saying, like, don't worry, guys, it's got nothing to do with the economy as a whole. I'm not so sure that's the case. But the reading is also much lower than the average monthly gain of 194 over the prior 12 months. Employment continues to trend up in healthcare, government, but in contrast, temporary help services lost 49,000 jobs. That's not a good indicator there. And temporary help, that's not a function of hurricanes. The temp jobs are the first thing to go away when the economy slows. So I wouldn't chalk that one up to Hurricane Milton, to be honest with you. Employment in manufacturing declined by 46,000, reflecting a 44,000 fall in transportation equipment. Now, it's pretty clear that the lion's share of those is due to the Boeing strike. You had about 33,000 Boeing workers went on strike. I'm sure you had a few thousand other jobs got furloughed because of the Boeing strike. But we've also had a lot of stories about job cuts in the automotive space recently, too. So I wouldn't be so dismissive of those manufacturing jobs going away, just saying, oh, it's the Boeing strike. A lot of those are going to come back, assuming this Boeing deal gets ratified, but I don't think they're all coming back. Also, if Boeing follows suit, like we saw with the airlines and like we saw with UPS and the auto workers last year, big wage gains following a labor dispute are usually followed by big layoffs. So maybe some of those jobs come back, but they're going to go away shortly after that. Employment showed little to no change in all the other industries. Now you can see here, guys, here's all the prior months of job gains averaging between 100 and 300,000, and then wham, all the way down here to October, plus 12,000. But again, if you count those very quiet downward revisions to September and the big downward revision to August, you're looking at a net loss of 100,000 jobs. Now, some other interesting tidbits here. The unemployment rate was unchanged at 4.1% for October. It was also 4.1% in September. But as my moderator, Mish, pointed out, that's just barely, because back in September, the unemployment rate was actually 4.05. And so we round up to the nearest tenth. The unemployment rate was reported at 4.1%, even though it was very close to being reported at 4.0% last month. Well, this month we're actually at 4.14, which means we're rounding down to 4.1%. So within the rounding errors, if you will, or the significant figures, you've got masking a 0.1% increase in the unemployment rate from 4.04 to 4.14, although both of those show up as 4.1% when you round it. Shout out to my moderator, Mish. Good catch there, brother. And on top of that, let's see, we've also got the labor force participation rate. It ticked down by a tenth to 62.6 from 62.7, still within the band that has been for the last couple of months. And average hourly earnings actually ticked up a little bit here, up 4% year over year. That's a good sign for American workers. That exceeds the rate of inflation, at least that reported by the government. So wage gains are outstripping inflation. They've been doing so for the last couple of months here. But again, long overdue and nowhere near enough to make up for what we lost in 2021 and 2022. Now let's shift gears a little bit to Apple here. We got Apple sparks concerns with tepid forecasts and China weakness. The company predicts lackluster growth for the holiday period, and Apple has struggled to rebound in a competitive China market. Apple, heading into its most critical sales period of the year, sparked fresh concerns about revenue growth and lingering weakness in an intensely competitive China market. Following the company's quarterly earnings report, Apple said that total sales in the December period will rise by a percentage in the low to mid single digits. Analysts had been projecting a 7% increase. The company also posted a decline in China revenue last quarter, falling short of estimates. The broader picture shows a company still trying to rebound from one of the longest sales slumps in its history. Revenue had declined 4 straight quarters in fiscal 2023 and only returned solidly in the past 2 quarters. Apple remains the most valuable company on earth, but it's had to contend with a sluggish smartphone market, more competition in China, and regulatory scrutiny around the world. That last point, regulatory scrutiny, that was a big one. That cost them $14 billion in this quarter. If you account for that $14 billion, earnings per share were down 44% for Apple year over year. That's masking, of course, your earnings were up 9% year over year if you take away that $14 billion hit. Services revenue up 12% year over year. That's pretty fantastic, actually. Apple services did $25 billion in revenue alone. Not even the biggest part of their business there. So that growth continues. Total sales up 6.1% is a little bit lackluster. Now, guys, the interesting thing here, Apple is just barely returning to growth. But if you look year to date, Apple stock is doing fantastic here. I mean, started the year at 191 and now it's at 225. That's multiple expansion for a company that's only recently grown just barely. Now, Apple stock is down about 1.8% ahead of the opening bell here, trading at $221.75, off by about $4. So the market did not like those Apple earnings. Amazon, meanwhile, different story here. Amazon keeps profit margins in orbit, and the e-commerce giant's strong operating earnings offset a huge jump in AI spending and counter worries of margin decline. So much like with Facebook or Meta is spending a ridiculous amount of money on cash-burning growth stories like the metaverse and goggles and stuff like that, but their advertising revenue was offsetting all of that spend. Amazon, you've got the same thing. Their core business is doing very well, and so that's offsetting all the capital they're burning to buy these GPUs. Like its big tech rivals, Amazon is spending a king's ransom on artificial intelligence. Unlike them, it also has plenty of customers dropping money on toothpaste and razor blades. That strange brew proved a potent mix for the company's third quarter earnings report. Amazon reported an eye-popping $22.6 billion in capital expenditures for the quarter, a new high and an 81% jump year over year that exceeded even the substantial CapEx increases posted by Microsoft, Meta, and Google parent Alphabet for the same period. Analysts had been expecting Amazon spending to rise 42% to about $17.6 billion for the third quarter, according to data from FactSet. So Amazon is still spending big on those data centers, on those GPUs. They're using the money they're making from everyday items to finance that expansion. Investors haven't been taking such surprises well as of late. Meta and Microsoft saw their share prices slide around 4 and 6% respectively yesterday following their reports for the quarter. But Amazon had some good news in store too. Total revenue grew by 11% from a year earlier, beating Wall Street's targets and marking an acceleration from the 10% pace shown in the June quarter. Amazon credited demand for everyday essentials, products for helping lift sales. So it's not AI that's driving Amazon's growth. They're selling more toothpaste, guys. That's what's driving this here. And then they're taking the money and they're buying GPUs with it. And the company's operating profit came in at $17.4 billion, nearly 19% above projections. Now, that's being driven by their cost reductions, i.e. cutting people. Amazon's share price jumped more than 5% in after-hours trading, and it's looking even better than that here. Amazon is up 6.77% here, trading at $199. That is up by $12.62. So, Amazon's big CapEx spend, that's money that is being pumped directly into NVIDIA's earnings. And remember, Amazon's doing that because Amazon builds these big data centers, and then they rent those data centers to companies like Anthropic, who Amazon owns a big stake in. And how does Amazon own a big stake in Anthropic? Well, Amazon gives data center credits to Anthropic in exchange for equity for the company. And then Anthropic redeems those data center credits by renting Amazon's GPUs, and Amazon reports it as revenue. Ta-da! The AI bubble. That's how this thing works. Every single big tech company is doing it. It is one massive accounting fraud. And, well, looks like they're still getting away with it, up 6.7% ahead of the opening bell. Now, let's talk about Boeing here. Sweet deal for Boeing workers here. They haven't approved it yet, but this looks pretty good. We've been here before. We had similar offers that were rejected. But Boeing union endorses the latest offer to end the crippling strike. Tentative deal offers 38% raise and a $12,000 ratification bonus. And the union of 33,000 machinists is set to vote on November 4th, so just 3 days away here. Boeing and union leaders representing 30,000 striking workers reached a tentative agreement to end a lengthy labor dispute that's crippling the company's commercial airplane manufacturing. The company's latest proposal would boost wages by 38% over 4 years and give workers a $12,000 signing bonus if it's approved. The International Association of Machinists and Aerospace Workers said this in a statement. IAM District 751 urged its members to accept the Boeing offer and end the strike, warning they risked losing gains they've made after weeks of collective bargaining. The union plans to hold the vote on November 4th. And right now, the market is liking this one up 2.27% here for Boeing shares at $152.70. Now, we've been here before. Boeing had a pretty decent offer on the table a few weeks ago. The union rejected that one. Strike is in its second month here. I mean, it's pretty obvious. Boeing raised a lot of money. They raised $21 billion last week. So Boeing can sit here and eat this strike for another year, year and a half. It'll cost them, but they can do it. And right now, Boeing workers, they got a pretty good deal. Not just that 38% raise, not just the $12,000 bonus, but there's other goodies there, like a 100% match on 401ks, up to 8% of take-home pay. That's an incredible retirement plan. That's better than I've seen anywhere else. So I'd be very surprised if the union didn't accept this offer. Let's just put it that way. And we've also got earnings today from the big oil majors, and they weren't that good, but the market was expecting pretty bad anyway. So far, they're taking it pretty well. Exxon and Chevron deliver earnings beat, but only one super major hiked its dividend. Chevron and Exxon reported better than expected third quarter earnings early Friday, even as both U.S. super majors saw profits drop significantly compared to a year ago. Meanwhile, oil prices rose modestly off their recent lows, and natural gas futures were effectively flat versus the start of the year. ExxonMobil reported earnings fell 15%. Let's see what else we got. Chevron announced third quarter profit decreased by 17%. So we got similar drops in earnings per share here, 15 and 17% for the two majors. ExxonMobil also announced that it increased its fourth quarter dividend by 4% to 99 cents a share after returning $9.8 billion to shareholders in Q3. Chevron returned a record $7.7 billion shareholders in Q3. Now, it looks like Chevron did not opt to raise their dividend like ExxonMobil did. Now, Chevron said their Q3 earnings decline was primarily due to lower margins on refined product sales, lower realizations, and the absence of prior year favorable tax items. Meanwhile, Exxon claimed its profit dip came back from lower crude realizations and higher exploration expenses. So, I mean, basically lower oil prices, guys, took a big chunk out of ExxonMobil and Chevron's earnings. Now, the company stocks are doing pretty well here. Chevron up 2.54%, trading at $152.60. And ExxonMobil is trading up 2.25% here, $119.41. That's up $2.63. So both stocks up about 2% here, looking pretty good. One more story regarding these oil majors. Check this one out, guys. Another, maybe a red flag for the labor market here in the States. Chevron flags possible U.S. job cuts in $3 billion cost cutting. So it's not just big tech cutting their U.S. workers. Now you got the oil majors getting in here. Chevron indicated potential U.S. job cuts as part of a new cost-cutting plan. The $3 billion in targeted structural cost savings will come from asset sales, the use of new technology, and workflow changes, Chief Executive Officer Mike Wirth said during an interview. Chevron recently opened up a $1 billion innovation hub in Bengaluru, India, which is hiring workers for engineering and digital services. We're going to change where and how we do some of our work, Wirth said in response to a question about workforce reductions. The center in India is an example of that. That does have implications on people because we're changing how work is done and where work is done. So isn't that just wonderful? Chevron is going to be firing American workers and replacing them with people in Bengaluru, India. And guys, this is an innovation hub they're talking about in Bengaluru. So this is not, we're not talking about blue collar jobs, right? That's very much prior decades. We already outsourced like 80% of the blue collar work in this country to China and Southeast Asia. Now it looks like we're going to be outsourcing the white collar work as well. So we'll see. Maybe that potentially a political debate around there. One of those candidates is not very big on cutting American jobs and shipping them overseas, you may recall. But Chevron looking to cut U.S. workers to save money, something we've seen quite a bit of in the last couple of years here from big tech. Now, I just want to say thank you very much to Beck. Thank you, Beck, for becoming a new member of the Melonheads. Welcome, Beck. Thank you for supporting the channel. I appreciate that very much. And also, Stephen Mine King says, I heard Janet Yellen was at a P. Diddy party. Guys, I'm not an improv comic. I don't know. Janet Yellen Janet Yellen going to a party at P. Diddy's house sounds like a dangerous endeavor. I just want to reassure everybody here, no, I am not a 12-year-old boy, despite all appearances. I understand I don't exactly look like a senior citizen female, but no, I'm not a 12-year-old boy. Please, Puff Daddy, please don't do that. Thank you. Take your hands off me. Yeah, Janet Yellen at a P. Diddy party. I don't get any warning about this stuff, guys. I just got to come up with it on the fly, I guess. Mighty Mike, 53. Thanks again, Stephen, for being a Melonhead for 8 months. Mighty Mike says 12,000 my posterior, 164,000 full-time, 220,000 part-time gone. Oh, somebody has been in the household survey. Mike, that's the afternoon show, brother, that you're just doing right there. So what do we got? Big changes in full-time versus part-time jobs. Multiple job holders are going up. So, Mike, I need seriously 15, 20 minutes to digest all the numbers in this comment and figure out where you're going with them. But I suspect it's more of the same. Are we still shedding full-time jobs, gaining part-time jobs, gaining multiple job holders? Does any of this sound familiar? Stop me if you've heard this one before. What Mighty Mike is describing here, guys, is the difference, the divergence between the household survey and the establishment survey in the jobs report. Now, some of my channel regulars, you guys know all about this because I've been pounding on the table about this story for months here. The headline jobs number that we hear about, since most people only read the CNBC headline, that's the establishment survey, which counts positions being filled, and then that gets reported as the jobs added. But what Mighty Mike is getting into is the household survey, which is a whole separate half of the jobs report that counts the people filling the positions. And you get a totally different story of the U.S. job market when you look at the household survey. You see people are losing full-time jobs that come with nice benefits, and they're replacing them with 2 part-time jobs that suck, that don't pay that much, that have no benefits. In other words, people are having to work twice as hard to maintain the same standard of living. Why? Because inflation. And Mighty Mike, thank you, sir, for being light years ahead of me on that. I didn't even have time to get into the household survey yet, but we will get into those numbers in more depth on the afternoon show today at 3:15 p.m. Eastern time. Thank you, Mike, for supporting the channel. And thank you to Gomers44, who says, thank you, Jack and Mods. Report that Boeing is dismantling its DEI department. Isn't that racist? No, I don't think it's racist to dismantle the DEI department. I think that was just a political pendulum that swung way too far in one direction, and now it's swinging back in the other direction. Boeing's job is to make planes, and I think Boeing is realizing when you don't pay attention to what your primary job is, which is making planes, parts of them start falling off. All right. I have no problem with diversity. I have no problem whatsoever with it, but it should not be a corporate priority. Your job is to make a product for a profit. That's it. I think the DEI thing went way too far, as did the, what was the other one? The ESG. It's another one, like just the alphabet people, you know, DEI, ESG, ABCDEF, whatever. Just stick to your core business, guys. Build planes preferably that don't kill people, and then worry about that other stuff. I just throw them out there. You guys do what you want with them. Thank you, Gomers. Appreciate the super chat, support of the channel. And thank you to Uncle Fedster, who says, happy Friday, Jack. Lamestream Media quote summary. Prices are up 20% since 2019, but wages are up 25%. So price affordability is 5% better. Bologna sandwiches. All right. And I said shit like 5 times on the live stream yesterday. So why do I use these like figgy pudding, like substitute cuss words every now and then? I don't know. It's totally arbitrary. But yeah, the mainstream media guys, this is like, there's this guy that works at the Wall Street Journal, Greg Ip, who is the worst example of this gaslighting the hell out of people by understating inflation and then being like, what's your problem, poor people? Don't you guys understand how good you have it? And drive down the street in any American city and look at the freaking tents on the goddamn sidewalk, and you can tell that is clearly not the case. So, yeah, this mainstream media thing, like, don't you guys remember there were always tents lining the sidewalk in American cities? No, there haven't always been tents lining the sidewalk in American cities. That's a new thing because people can't afford to live in houses anymore because Wall Street and Washington, D.C., along with Silicon Valley, they all collude to endlessly inflate asset prices, devaluing the wages and the savings of the average people, and we're all paying the price for it. And then they're like, oh, my stock is up. What's your problem? Can't you tell how good things are? With their pinkies up in the air. Man, you hit it. You struck a nerve there, Fedster. You pushed that button with the big red box over it that says do not push. Yeah, you got me pissed off. Greg Ip. Wall Street Journal, fire Greg Ip. He sucks. Sorry. There, I said it. The guy deserves to be living in a tent for this crap that he's been saying. Richard Bell, thank you. Jack, something more positive. I don't know. The weather's nice today. Richard Bell says, Tweety do putty tat Looney Tunes. I don't know what any of that means, Richard. Can somebody tell me what Richard is saying here? Richard, you're confusing me. Some of these are harder to interpret than P. Diddy or Janet Yellen at P. Diddy's costume party. Thank you, Richard. I have no idea what you're saying, but I am grateful for the sentiment and the support of the channel. I think he just wanted to hear me say Tweety Doo, Pooty Tat, Looney Tunes, I guess. Oh, I thought Pooty Tat. Is that what you're saying? Little Tweety bird there. All right. I'm as sharp as wet leather this morning. Thanks again, Richard. And thanks to Big Mouth Barry. Says, why is there a nearly 3-minute stream delay from X compared to YouTube? I don't know. I don't influence that decision. I don't know why X is 3-minute delayed. Maybe that's part of the whole kitchen sink thing that Elon did. Maybe that had some effect on it. I really don't know. Which one? Is it YouTube is 3 minutes behind or is it X is 3 minutes behind? I don't know, but I'm grateful to both of you, X viewers and YouTube viewers. Thank you guys for watching the channel and supporting the channel. And thank you, Big Mouth Barry, for the 5 minutes. I don't know what's causing that. That's on the back end of those two firms. I have no control over either of those. But thanks again, Barry. And thank you, everybody. Once again, we will be back this afternoon with a more in-depth look at the jobs report. We'll get into the nitty-gritties of the household surveys and see where the jobs are and where they're going away. Also, thank you, everybody, for the super chats and the generosity supporting the channel. I appreciate that very much. Big shout out to all my magnanimous melon heads on Patreon and YouTube. Thank you guys for supporting the channel. And, but Willie Gang, are you going to China for a holiday one day? Definitely not. They'll probably arrest me at the airport, Bill. Thank you for supporting the channel. I appreciate that very much. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.